In the 1920s, brokers were offering enormous leverages beyond the real capabilities of people to cover. With offering more leverage, they were earning higher commissions. They required investors to put in very little of their own money, thus attracting more people to the risky stock market. Leverage rates were up to 90% debt, which means people only had to use 10% of their own money. It was like winning in the casino, and it was not going to last. When the market started falling, many of those who traded on margin received margin calls. They had to either deliver more money to the brokers or their positions would be closed.
Since many people did not have the funds to cover their positions, their shares were sold, causing further market declines and even more margin calls. This was one of the major contributing factors that led to the stock market crash of 1929, which led to the Great Depression. The banks also contributed to the crash in extending too much credit and not maintaining enough reserves. Everyone got greedy, but then there came time to pay. The government introduced new regulations, but when it comes to earning money, there are always ways to trick people.
Let's talk about banks. Banks were originally created to store money. Religious temples became the earliest banks because they were seen as a safe place to store money. Before long, temples also got into the business of lending money, much like modern banks. They would earn on the difference between borrowing and lending. Based on the theories of economist Adam Smith, some 18th century governments gave banks a relatively free hand to operate as they pleased. However, numerous financial crises and bank panics over the decades eventually led to increased regulation, just like after the Great Depression. Due to regulations, they can't freely set any interest rates for credit they want, so they have to be creative in making more money in addition to regulated lending. So on top of charging you credit card fees and overdrafts, they will charge you paper statement fees, monthly or annual statement fees, telefees, return deposit fee, foreign transaction fee, lost card fee, found card fee, redeeming reward points fee, return mail fee and activity fees, interchange fees, and just as a bonus, if you want to stop using their services, an account closing fee. Some countries have even implemented negative interest rates, so you have to pay for the privilege of holding your own money in your own account. The banks have always used your money to create more money with lending, but again, there is always room for creativity. Every time a bank makes a loan, under banking regulations they're required to set aside certain reserves of capital for the loan, in the event the loan is not paid off at 100% as expected. Well, of course, if you don't have to do that, and if you're a bank, you'd prefer not to do that, because then you can finance more freely and take on more debt. So banks have created swaps to be able to loan more money. They would find someone who could take on their loan risk and free up capital. That organization would receive compensation from the bank for taking on or assuring credit risk. And so risk was essentially dispersed. This was a major financial innovation. Credit derivatives made it possible for a bank to skirt capital requirements. And that's what happened. The amount of capital the banks had to hold got less, and so banks became able to create more and more credit. They could make more loans. The rest is history. Just like before the Great Depression, when a lot of credit is given to those who can't pay, eventually it's going to collapse. In the Great Depression, the Fed led the banking system and the money supply collapsed, but in 2008, it bailed out the banks because the banking system is important to society. The housing bubble burst, causing the fourth largest investment bank, Lehman Brothers, to file for bankruptcy. At least 29 trillion was used to bail out the financial system during the crash. The American people were told that this was necessary to save the economy, not because banks were gambling with people's mortgages and creating money out of nothing, putting everyone at risk. When any other business fails, it goes bankrupt, but not banks. Banks are important. We were told the collapse of Wall Street giants would freeze the payment system and people wouldn't be able to get credit. Businesses wouldn't be able to pay their employees, and that's why the big banks need to be saved. and that's why the government needs to help them, courtesy of taxpayers. In fact, they were bailed out for doing a bad job and making money on everyone else.
Out of the $29 trillion in bailouts, 8.2 trillion were given to the 6 biggest banks in the country, the 6 mega banks, during the 2008 crash. So nearly 1/3 of all the bailouts went to them. And the executives got massive bonuses from these bailouts. This was a massive transfer of wealth from Main Street to Wall Street to prevent the bankruptcy of just 6 banks, supposedly because they were vital to the economic security and prosperity of Main Street Americans. The bailouts were not only given to banks that take deposits and make loans, they were given to all kinds of financial institutions, including those engaging in the most dangerous, high-risk activities that actually caused the financial crash. So financial institutions like Goldman Sachs, Morgan Stanley, AIG, and others were allowed to maximize their profits with almost no regulation. But when they caused a crash, they were bailed out by the government. The history repeats itself. Every following crisis is caused by years of printing money, and the people that benefit the most are the big guys. The Fed prints money, so they can have as much money as they want. The big banks make money, and if they fail, they get bailed out. And the financial services industry finds ways to get money out of the people, especially at the promise of good returns on investment. You don't believe me? Look at these charts. The light blue line is financial profits since 1970s. It's growing. This is the revenue of one of the largest brokerage firms in the US, Charles Schwab. It's growing. This is the revenue of Robinhood. It's growing. And this is the household savings since 1970s. Can you see the trend? We have looked at the role of the banks. Let's look at other players. We'll start with brokers.
The broker's reputation has always been a notorious one. In 1984, Washington stockbroker Les Silverstone walked into the office of Arthur Lever Jr., the chairman of the Securities and Exchange Commission. He had things to say about how Wall Street's biggest brokerage firms routinely scam their investors with business practices Silverstone described as deceptive and unethical. The consumer is getting ripped off. The contests inside firms create a culture that is detrimental to the consumer. What you need from your broker is best thinking about how to achieve your long-run financial goals, is exactly what the contest is forcing the broker not to give you. Sales scripts are used in many industries as an accepted way to generate business, but Silverstone said brokerage sales scripts often get around the intent of SEC regulations and lead to bad advice to customers. What broker is going to advise his clients to sell a poorly performing fund when he is getting paid thousands of dollars a year to keep them invested in it? Retail investing gave even more people access to the market and once again showed that the companies providing services care much more about their own pockets than about their clients' pockets. Just like in the 1920s, a big percentage of those inexperienced investors would lose money in the crash, selling low and buying high. The market works for the big guys, not the ordinary people.